The 2026 Jackson Hole Economic Policy Symposium will be held from August 27th to the 29th. It's of great interest as the Federal Reserve weighs on two significant concerns. Inflation remains above target, while U.S. hiring has weakened. But what does this mean for us as these concerns arrive at the forefront of discussion? You're listening to the Pulse 360 podcast brought to you by EBC Financial Group. I am your host, Norman Chella, and with me today to talk about this is a returning guest, Precious David, Senior Market Analyst at EBC for the Nigeria branch. David, welcome back to the show.
Yeah, it's a fantastic time to be here, and really excited for this one because it's really something that a lot of traders are looking towards and talking about, because it's really going to be doing a lot to how we see the markets in the coming months.
Great. I think I think that is an amazing transition to get into it, because speaking as someone who could be a budding trader or an experienced trader, no matter how long I have no matter how experienced I am into investing as a whole or trading as a whole, am I that informed about the Jackson Hole 2026 is another question altogether. So my first question, David, is for those who do not follow the central banks closely, what is the Jackson Hole Symposium and why do markets pay attention to it?
All right, so see it this way. Imagine you have the opportunity to be in the strategy room of your favorite football team, where they would be discussing the next strategy for the next game. And you have the opportunity to be able to get a first-hand clue of what the team is planning, how they are going to go about their game plan. And then you can, based on your own experience, you can really analyze to see if it is a very good game plan or if it is something that might not really work out. So this is what the symposium is all about. It's just the gathering of bankers, economists, and policymakers coming together to discuss global economy and to be able to, discuss strategies around global economy. Now, I would like to say that this is not really an official rate decision meeting. It's more of an hint to what to expect with the rate decision.
You did mention that this isn't official. It's more of a discussion. So if we run through that, how do we say this? If we run through that analogy of looking into the strategy meetings of a football team, or in this case, the decisions and discussions to be made and the necessary preparation, what should I consider or pay more attention to, and what should I avoid reading too much into?
Okay, I think one of the major things that traders should be able to pay attention to for the Jackson Hole Symposium is the statements of key influential policymakers around the economy, mostly around inflation, data, and employment, which is major right now. So understanding how those statements come across can give you a hint as to knowing what the official Federal Reserve team are planning to do in the coming rates meeting in September.
These discussions, how they are stated, the ways in which they're expressed, I take it that they don't necessarily move markets, but they merely indicate. Is there an extent in which I should consider or observe or deconstruct them when I'm listening or into the symposium?
Yeah, interestingly, you see, I think in my experience as a market analyst and also a trader myself, who have also been able to tutor a lot of people in the last 7 years, a lot of traders make this huge mistake. And the mistake is they want to trade the headline. They want to jump into the headline and trade the headline. Most times they are jumping into the markets too early because of a single statement without really waiting to digest the entire meeting and to see the possible direction that the Federal Reserve would want to take in their next federal rate meetings, So I think it's very, very important that, traders understand that You should be able to avoid what is called fear of missing out, because when the market begins to move on a single statement, it's not going to be sustainable. You want to really pay attention to what the entire language of the statement is talking about, what the entire meeting, the direction of the body language of the policymakers, of the economists and the bankers, what they are actually looking at, what is giving them more concern. Is it interest rates? I mean, is it inflation rates, or is it employment data? What is making them more concerned gives you an idea of what they are actually or what direction they would actually be taking. So not just trading a single statement, but actually paying attention to the body language of the entire meeting to see if there is a major discussion on whether or not inflation is high, or there is a major discussion on the concerns around the labor markets due to the employment rates that are dropping massively in the United States.
Yeah, you've hit the nail right on the head here. As mentioned in the intro, when we're considering what the concerns are, I've noticed that these two topics are right at the forefront, David. And from what you've explained, it seems like the statements surrounding them, the way that they're explained, the way that they're elaborated, this becomes key to comprehension of the symposium as a whole. So let's get right into the actual concerns themselves rather than the event, which is the policy problem. Why is the Federal Reserve focusing on these two particular concerns, and why are they facing a difficult choice between, say, inflation and employment?
I would say that listen, I've spent some time to really look at the policy issue, and it's quite interesting, you know. So let me break it down for people who don't understand what's going on. So United States, at every time, the policymakers in the Federal Reserve, they try as much as possible to keep the interest rates, inflation rates at 2%, right? At 2%, it means the economy is not too slow, which means people can get employed, people can actually get good wages, you know. At the same time, it's not too high to flood the economy with too much cash or too much money. Because when that happens, the prices of things becomes increasingly high because less value, commodities begins to get less value, housing and all that, and then you begin to experience what is called inflation. And the reason why this symposium is quite interesting is because now based on the CPI data for July, inflation is currently at 3.4%, about 3.41%, which is not at the 2% mark, right? And so the Federal Reserve are actually thinking of, should we increase the interest rate, which eventually brings down that inflation, or should we not? Now, why they are having that dilemma, or why they're having that discussion, now the job reports, the employment report and the job report from July is not looking so good as well, you know. The non-farm employment change is showing a minus 20,000 in terms of number of jobs, and we are having about a 4.1% unemployment rate, which tells you that the economy is already slowing down, even with inflation still being a problem. You understand? So it's more like a two-edged sword, or will I say a snake with two heads, you know? So if you try to hold one head, the other head bites you. If you try to hold it, so you need to be very meticulous, and you need to be very strategic, you know, to be able to deal with it. And I think one of the things that we are going to be seeing in the symposium is we are going to be seeing the body language of policymakers tilting towards probably inflation data or employment data, because what I think they might want to be talking about is which one is actually a major problem and which one should we tackle first. Because I tell you, they might not be able to tackle both of them. But this is what makes it interesting, because at the end of the day, you, beyond just knowing what to do or knowing what to trade if you're buying or selling on any instrument, it's more of how would they solve this problem? What would they do? What strategy would they put in place? What policies would they make to be able to solve this problem? You know, and that is why this year's symposium is quite interesting.
It's a very interesting dilemma, and I would say the analogy of having of having a snake with two heads, which is basically two different sets of problems just intertwining with each other, seems like almost an arena, like a battleground of setting the right policies to balance between these two concerns, because these two, both the problems exist. They need to be tackled, and it's a matter of prioritizing which one, or at least recognizing whenever a policymaker issues a statement or expresses with a speech or maybe a solution, which problem are they willing to tackle at this point in time?
Absolutely.
Which brings up the question. You did bring up the data set of July's employment data. How much weight should the Federal Reserve place on 1 month of data? Should they consider beyond just 1 month, or are they just focusing all of their potential solutions and suggestions and modes of action based on what happened in July?
Okay, so there's a statement as a trader. There is a statement you would always hear that past performance does not guarantee future results, which means there is nothing set in stone. But I would also like to mention that the data that they have to work with right now is that of which I think they are going to be discussing majorly, is that of last month. We're going to be having more data by next month for August, which is now going to be a major push or a major definer of what is going to be happening in the Fed meeting in September, which is very, very huge. But I would like to say that though it's just 1 month of data, it's huge data, because when you look at the gap, we're talking about minus 20,000 jobs. And we're talking about a 4.1% employment rate. And then when you factor this in with the inflation at 3.41%, it's huge, right? So you don't want to increase interest rates too much if you know that there is already a slowing economy happening already. At the same time, you do not want to just pay attention to just one data, just like what we're discussing, to be able to make a decision to bring down the interest rates, because we could have a better performance in August. Nobody knows yet because the data is not out yet. But I'm just saying that, you see, for this symposium, I think it's really going to be an interesting one, because beyond just what traders are expecting, it's also a time that policymakers are really going to be on their toes, while we're waiting for the August data to come up to really solidify what the employment situation is looking like in the United States, I could say that right now is a concern. But whether it's a bigger concern or not, we have to wait to see what the symposium is going to be talking about.
The anticipation for that would be quite fascinating to witness, because, yes, like you said, past performance does not equate to the trajectory that seems linear, seems to be expected, which brings up another question that I have, which is around September, which is the upcoming month that we have the natural consequence of what this symposium will essentially set the tone for, what we're supposed to expect as traders, what we're supposed to expect as investors. So I do have questions for you about the September rate. What would strengthen the case for a rate increase, and what would support another hold?
So there are 4 pillars everybody should be, and I'm not just saying everybody. I mean, there are 4 pillars that even the markets are actually looking at right now, which are going to be discussed vividly in the symposium. And these 4 pillars: number 1 is wages, inflation, employment, and we're also going to be looking at trying to remember the 4th one. So we have wages, we have interest rates, we have employment, and of course we have the growth, because we're going to be having the GDP coming up very soon. I think on the 27th of this month we're going to get the GDP. So economic growth, employment, wages, and inflation. These are the four major pillars and four major determiners of what we are going to be expecting for September. So right now, the data for August is very, very important. Everybody should be looking towards that data, because this is really, really going to give us what to expect for the September rates. Already we're going to be having the GDP by 27th of the month, which is also going to be supporting. And funny enough, the GDP is going to be out almost at the same time the symposium is starting, which means I'm sure this is going to be also discussed. So it gives you a holistic view of what you should be expecting for September. And once more, it's not just about a single statement coming from maybe an influential policymaker. It's more of the entire message that everyone is trying to pass across in the symposium, the entire body language that they're trying to pass across in the symposium. Is the economy slowing down? Should we increase interest rates based on the fact that the economy is slowing down? Or should we reduce interest rates based on the fact that the economy is slowing down? Or is the economy strong enough to bring the interest rates down? These are going to be determined by these four things: growth, wages, inflation, and employment.
I feel that the fact that the GDP data set coming out on the day that the symposium starts is going to potentially shift the potential expressions and language used by policymakers on the day that it starts, where statements might change and mix, and you'll see this almost push and pull for leaning towards addressing different concerns, which brings which brings up the question: what kind of language would suggest a more positive inclination towards a higher rate when you have these data sets? If you have all four pillars already, and then GDP out on the day, what kind of language do you think would be a very important pattern to recognize that makes you think, oh, some of these officials, some of these influential entities or figures are more open to higher rates, basically?
I think already based on the last interest rates meeting, where the interest rate was set at 3.5 to 3.75 basis points. We had a 9-3 vote, which means 3 people out of the policymakers wanted an additional 0.25 basis points, which is about an additional 25% on the interest rates and of what we have right now. So this tells you that the House is not actually united right now. There are some people. So let me just share what I think with you. So there are some people among the policymakers who believe that the economy needs more interest rates, which means that they believe that inflation is more of a concern than employment or than what is happening with the labor markets, right, in the United States. While we have other people who believe that employment is more of a concern than what we have. So it's more like a divided house right now. And these major 4 pillars are really going to be helping more people to move to which side, either the side of who wants more interest rates or the side of those who actually want the interest rate to remain the same or to bring it down. So the body language that we want to see to be able to really know and be able to really determine what's going to be happening in September is a body language that puts one ahead of the other. So if an influential policymaker is talking more on the interest rate or saying, oh, right now we have a very strong economy, and the statement is looking very hawkish on the economy, talking about how stable the economy is looking, and talking about how reassured they are that the inflation data is going to be better in September, or it's being worked on, then it shows that we might actually have a possible interest rate hike in September. But when we now begin to have somebody who is coming in to talk about to tilt towards the employment situation, which is in the United States right now, and to tell you, okay, for example, he's saying something like, oh, we are aware of the situation with employment or the labor market in the United States. We have seen the data from July, and we are doing our possible best to make sure that the economy doesn't slow. Then you know that this is very dovish, and it means that they are more concerned about the employment situation and the labor market, which means we might be seeing the interest rate remain the same or being brought down right now, I mean, for September, So these are the things that I would want to pay attention to as a trader. But then again, remember, it's not just one statement. It's more of the message that is being passed across. It's more of where they are tilting towards more, and you are able to understand and pick, that particular body language. Because when it comes to, I understand that when it comes to the Jackson Hole Symposium, traders really want to jump in at the heat of things, and we have a lot of things happening in that period of time, so you begin to have a lot of ups and downs. So you need to understand as a trader that it goes beyond that. Most of the times, in my experience, the market eventually moves in the direction of the entire message. So what I'm trying to say is a statement could come that could suggest that probably interest rate is more of an issue. I mean, inflation data is more of an issue than employment data. And then people jump into the market, start to, go in the direction of what the market is doing. And then at the end of the day, when the real investors, I mean, the 70% and 80% of the market's capitalization now sit down to really analyze what the policymakers' body language looks like. And then they can now say that, okay, I think they are more concerned. They are obviously concerned about the inflation data, but they are more concerned with the economy being slowed down. And then before you know it, you begin to see the market move in that direction for a longer period of time. So it's not just you trading a one-off statement, but you really paying attention to what the entire message is talking about.
I'm trying to understand the gravity of what this message could be about, because it seems that we want to capture to what extent is one concern a priority over the other. If we're looking at the messaging of a particular policymaker or an influential entity saying, hey, inflation rate is around this time, or is around this much, but my current concern is over the fact that we need to consider the potential consequence of the labor market being at these current rates. We need to address them, or we should consider addressing them. And if we look at maybe a percentage or a ratio of how much of that is where most of their attention is being put at, then maybe that is where the inclination starts to emerge. That is when someone who is observing the symposium would think, oh, okay, they've had 3 days of potential discussions to conclude that this concern holds much greater weight than the other. I'm curious about this. This might be a bit of an aside, as someone who could be a trader with much experience or someone who isn't so exposed into the symposium as a whole. If I were to bear witness to these statements or these expressions, what could I, or even markets in general, misinterpret if you hear these statements, and maybe certain language could be used that could mean something that you could infer, but it could mean something else? Do you have any concerns about that, or are those like potential conditions that you could always have a bit of like a shadow of a doubt behind you as you're listening into these statements?
Okay, so the first thing is for traders, I would say that you, as a trader, you should not listen to the symposium just because you're looking for a quick entry to a spike. So most of the times when these statements are said, it causes a spike in the market on gold. It causes a spike on stocks and also index. You also have spikes on every dollar pair, major dollar pair, Euro, USD, USD, JPY, all the major dollar pairs, So you should not just, because I think that's where a lot of traders miss it. That's what a lot of traders misinterpret. A lot of people go to watch the symposium, mostly on the first day, on the opening day, and they're trying to watch out for influential figures who are going to come on the podium to really talk about, mostly influential figures coming from the Bureau of Statistics of the Federal Reserve, who are going to be coming on the podium to talk about, give a statement on the economy and to give their own view on what the economy is looking like. And once that person says something, just like what you said, that talks about, they're paying attention to inflation data. Of course, they know about the employment level, but right now their attention more is on how to bring down inflation. Immediately in a trader's mind, you feel, this simply means there's possibly going to be an interest rate hike in September, and then you jump in to buy gold, for example. To sell gold, for example. In that case, what you are actually doing is trying to trade the spike. And I tell you, most of the times, if you are not careful, it could actually mean trouble, because most of the times those statements can be easily reversed. Most of the times you get, because you see, these policymakers, like I said, they are just coming together to give you a hint, to discuss the economy, but at the same time, they are not allowed to really share too much with you. And the decision still weighs heavily on the data. The decision still weighs heavily on the data that's going to be coming for August. So whatever any policymaker is saying, there are two things that you're going to be doing. Number one, they're not going to be giving you the full picture. They're just going to be giving you a hint of what's going on. At the same time, they do not want to sound too certain of whatever is going to be happening because they don't have the data set yet. So it's really not a time to actually jump into trade spikes. It's more of a time to understand the long-term decision you're going to be making on instruments like gold, stocks, index, currency pairs that has to do with dollar. And you really want to know what their long-term trend is going to be looking like, even between now and September and beyond September. And that is actually going to give you some very, very good understanding of what the September rate decision is going to be looking like as well. So one of the major things that you should pay attention to as a trader is not to jump to conclusion. Not to jump to your own conclusion, because your own conclusion might not be their conclusion, even though they might be sounding a bit hawkish or a bit dovish. You should not conclude for them and just say, "Oh, I think this is what they are saying," because you might be far-fetched from the truth.
I think it bears such importance to note that they are only hinting based on the data set, as opposed to something so conclusive that you would say, oh, yes, what I'm thinking is what they're thinking. And that is probably where most people would potentially misinterpret, because we could infer in a different direction, because our principles and patterns could fundamentally be different from those who are giving these statements. You mentioned these markets. You mentioned the buying and selling of gold. You mentioned specific currency pairs. Are those the main markets you'd be considering to look at after a major speech or two, or are you considering others as well?
Yeah. So when it comes to the interest rates, this is how it works. Not just the interest rate. When it comes to majorly the interest rates. So this is how it works. There are instruments that are very well tied to gold. I mean, tied to the dollar. So for those people that don't understand, because I think I used to have that problem as a trader when I was starting up. A lot of times they say, "Oh, interest rates, this, interest rate that," and I'm always confused. Like, how does the interest rate affect the market, affect gold, affects? So let me break it down. Basically, what interest rates talks about is it's a mechanism, it's a tool to control inflation. Now, I'm not going to go into that. I'm just going to go into why it is important for you to pay attention to it as a trader. Interest rate basically means that if it is being increased, what they are doing is that they are increasing the amount that you would pay on interest when you borrow money from the bank, and that discourages you from borrowing money, which makes you to want to save your money in the bank as maybe a treasury yield, and or you want to buy some government securities or bonds or whatever, and this actually helps you to make more money. So anytime an interest rate hike is done, investors begin to pull out their funds from different assets like crypto. They also pull out their funds from the stock market. They pull out their fund from the index market. They pull out their fund from gold, and they begin to put that fund into the United States Bank, buying government dividends, buying government instruments like the treasury yield, because they know that with that high interest rate, they're going to make more money. Now, the reverse is the case when the interest rate is brought down or is being cut. When there's a cut in the interest rate, they begin to pull out their money from the bank, from the central bank of Federal Reserve, and then they begin to distribute that money into other more profitable instruments like gold, stocks, index, and crypto. So there is a very good relationship between gold, the stock markets, and which also has to do with the index markets, the crypto markets, and what the interest rate is looking like. And this all relationship bears so much foundation on the strength of the dollar. So what the interest rate actually does is weakens or strengthens the dollar. When an interest rate is being increased or is being hiked, the dollar becomes very strengthened. When it is reduced, the dollar becomes very weak. Now, what you need to pay attention to is that when you are trading gold, the symbol for gold is XAUUSD, which means dollar is the quote pair for gold, which means gold is the base pair. So you are trading gold as against dollar. So what it means is that if an interest rate hike is being done and dollar is strengthened, right, generally, it means gold would also become less strengthened. It means gold would lose value to the dollar. And so therefore you want to sell off your gold to buy more dollar. You understand? The same thing if the reverse is the case, where the interest rate is being cut, then the dollar becomes weak and you want to sell off your dollar to buy more gold, and then the demand for gold becomes more. Same thing for the stock market. When the interest rate is high, a lot of people want to sell off their stocks to buy gold, or whatever stock they're trading. The reverse is the case when the interest rate becomes low. So different market like that. So, but the major thing, it depends on what the trader want to trade. The major thing you want to pay attention to, or the major instruments that we should have, or categories of instruments that you should be looking at to, is currency pairs, major currency pairs, that is USD/JPY, major Euro USD. You want to pay attention to gold. Gold is major. Gold is major because of the weird relationship it has with the dollar. You understand? You also want to pay attention to stocks and index as well. And I think these are the major heavy hitters when it comes to trading. These are where investors are actually also paying attention to. Investors most times might not be so sweet to pay attention to currency pairs, but I tell you, gold, silver, stocks, index, these are their major points. And of course, treasury yields as well. So you want to pay attention to these levels, and if you are able to understand what the data is saying, you're able to really digest the message from the symposium, you can really get, a futuristic view of what the decision is going to be looking like in September, and begin to position yourself for the outcome.
Yeah, this seems like the markets that are most, I wouldn't say affected, but maybe the most sensitive to any changes in interest rate, whether a hike or maybe a lower. You start to predict that, certain investors, certain traders will start to consider patterns of like, okay, taking it out of this vehicle and moving into this vehicle because it's in conjunction with what at what rate are we working from this month or next month onwards. You mentioned crypto.
Absolutely.
That brings up an interesting question, because that was not a market that you mentioned would be a first look in a speech. It could be one of the vehicles that could be involved for a trader if they could, potentially put into it or put more. I did read up on the Jackson Hole Symposium, noting that financial innovation is one of the potential topics that would be talked about in the statements and speeches. Crypto could be one of those, but what does that mean from your point of view? I would like to hear your take on that.
All right. So for many years right now, the Federal Reserve and every other central bank have been trying to come up with discussions around regulation of crypto. Because cryptocurrency is growing so much that if not properly controlled and regulated, it could actually have more of a stick than a carrot to the economy. You know what I'm trying to say? So you need to understand that it's a major concern also for a lot of economists and bankers around the world, and also policymakers, because we cannot deny the fact that crypto is here and it's really doing a lot of good. For example, take a country like Kenya, for example. Majorly, their transactions are done via what is called M-Pesa, which is a token, and they really do not they really do not encourage any paper cash anymore over there when it comes to transaction. Most everybody uses M-Pesa,
Interesting.
Take a country like Nigeria as well. We have a huge market for P2P right now. A huge market for P2P merchants right now in Nigeria. Not just Nigeria, all across Africa. A huge market. And we are having a lot of exchange coming up right now to actually make it easier. For example, there's a new company right now in Nigeria where you can walk into a bar, buy a drink, and pay directly with crypto, and then the owner of the bar gets his payments in Naira instantly. So it's really becoming a major topic on the global front. And I think the symposium will really do well to actually talk about this and discuss around this and see how majorly they can come up with a proper regulatory system that is going to really checkmate and balance, a lot of issues that we have in that crypto front right now. They said the issue of stability, the issue of very high volatility as well, mostly with major coins like the BTC and the rest. So it's something that we have to look towards because it's something we need for our day-to-day activities. It has shifted the entire landscape for payments and services. It has shifted the entire landscape of how we see financial movements and how money moves from one continent to the other right now. And it's something that I think, if properly structured, could really be an advantageous tool to strengthening the economy, because it's the future of money, it's the future of finance. So it's very, very important that we also pay attention to that front.
Yeah, I noticed that it's becoming such a day-to-day part of routines, especially even in Asia as well. Like we're seeing economies pop up based on tokens and coins changing from tokens directly into currencies that are what we are normally used to, yet all of your daily necessities are turned from a digital token. And the fact that we haven't yet established a minimum critical threshold of regulatory policies and discussion and systemic understanding of the impact of stable
Yeah.
coins as well as tokens of different kinds means that I would say that it is a positive outlook on the role of stable coins now and forever on, because like you said, David, we're already seeing it in
Yeah.
buildings and businesses, in regions and locations.
Yeah.
I'm seeing it from my end as well. And as someone who is notably informed about crypto, I understand the gravity of it. I understand the importance of it. But why should people, I would say traders and also non-traders who are not involved in crypto in any capacity, care about this part of financial innovation? Why should they care? Is that something that they should consider reading more into? Do you believe, David, from your point of view, for someone, maybe one of our listeners here, who does not know anything about crypto, should they at the very least gain a minimal understanding of the potential impact of it in these discussions, or should they still just proceed with what they have right now?
I would say that for everybody listening to this podcast who probably does not have a very good knowledge about crypto, it's a very essential thing to have right now. Mostly if you're somebody who wants to come into the financial space in any way. With crypto right now, you can actually okay, let me give you an example of what I'm trying to say. I find it much easier to deposit and trade and withdraw with crypto, with a stable coin like USDT, for example. I'm not saying USDT is the best, but I'm just saying as a stable coin, I feel it's easier. I have no problem depositing. In fact, it's much faster for me. It's much convenient for me, and it's much more reliable. It's much more reliable for me. So for me, it's giving me a lot of access to the global financial markets. I mean, instant access to the global financial market. So it's something that traders should pay attention to. And it's something that we cannot do without right now. Like I said, it's the future of money. There was a time where money was solid material, and then we moved from solid material like gold and silver, and then now we are dealing with paper cash. And now we are seeing the transitioning from paper cash to tokens. This is a transitioning happening, and it's happening so fast that you need to pay attention to it. I could say that in the next couple of years, we would begin to see more financial institutions trying to get a proper structure on how they can actually make transactions even much faster and much better using tokenized financial derivatives. So for traders who don't have much knowledge about this, I think it's very, very good for them to actually begin to look towards it, not just because of the fact that probably they want to, trade with it or not. It's majorly because of the access it gives you globally when you have the understanding of how it works. You know, with tokenization right now, you do not have any global boundary when it comes to financial movement. When it comes to moving money financially, you have no boundary. You could be in Nigeria, you could be in Asia, you could be in anywhere around the world, and you could have your business 100%, moving and established just by crypto. I've had to do a lot of transactions across the globe, across continents by crypto. So it's something that you should pay attention to as a trader, as somebody who is interested in building up a business, as somebody who is interested in what the global economy is saying. Yeah, crypto is something that I think it's a must for you to have proper knowledge about.
Yeah, I also believe in equipping yourself with the understanding that this kind of technology would result in the acceleration of business, the acceleration of faster payments, the acceleration of the I wouldn't say the lack of a boundary, but more so the fact that we can navigate through boundaries between regions, between different cultures, and between different activities that are transactional in nature, because crypto technology and the existence of tokenization is available there for you as a way to express more of what you need to do. Hence why I think it's even more important for them to even talk about this in the symposium, because sometimes, well, when it becomes faster, you did mention reliability. I would like to challenge that a little. Sometimes faster payments can, yes, consider maybe safer safer transactions or safer business activity, but would that also accelerate the spreading of stress? Would that result in potential human error being put up when transactions are done so quickly, so well done and globally around the world? These are potential worries that we could consider, and I think that's when the symposium is up there for you to bring up these points, especially if I'm not informed about the whole technology as a whole. So that's something that I would definitely look at.
Yeah, I
Now,
think
oh yeah, go ahead.
yeah, I just wanted to say something on that. You see, I'm going to give this analogy, very brief analogy. When the first bullet trains were made, they had a problem. Even though it was fast, it was efficient, there was a major problem. And the problem was the booming sound they make when they go through the tunnel. But when the proper structure was made, so the problem should not stop. How will I put this? The problem does not mask the efficiency or the importance of
Yeah,
the assets or of the tool, right? So in this case, the cryptocurrency is a necessity for economists to look at for right now. It's a necessity in our economy right now. So though we know these problems, right? But I think with the symposium, I think should be looking at discussing how they can have much better structure to be able to make this problem less of a problem and see how they can control this problem and be able to, transform the entire crypto space into something that could, become much more stable and much more reliable than what it is right now.
these are definitely expectations that we should hope for and work towards, especially when the introduction to new technology brings up these potential new cases and new challenges that could help us. But we'll need to inform ourselves and equip ourselves all the better. And that's why this symposium is much more important. And it would make me want to look forward to it more. So, David, once it ends, what should listeners follow or look at before the September Federal Reserve meeting? What should we consider? What indicators should we pay attention to? What are your thoughts?
Just one statement. Employment data. August employment data. Once the symposium ends, I think traders should pay a lot of attention to the August employment data. Then the non-farm employment change, the unemployment rates, and the average hourly earning that's going to be coming up by first Friday of August. That is really going to be the game changer. to really solidify what the language or the message, the entire message of the symposium has been able to present, So this is really going to be the turning point, or the nail that hits or the hammer that hits the nail on the head, kind of a thing, because right now, even with the symposium, the data are not still complete. We are still expected to have, even though we're going to be having GDP, yes, on the 27th, but at the end of the day, the Federal Reserve are going to be considering, alongside with what we have already on ground and what we're going to be having on the 27th and what is going to be discussed from 27th to 29th, they are still going to be considering the employment data that is coming up that's going to be coming up in August. So this is what I'm thinking, right? If the symposium entirety, the entire message of the symposium is tilting towards more concern for the employment data, judging from what we had in July, then you really want to pay attention to what August data is going to be talking about. Now, if August data is now coming bad as well, then it means you should be looking forward to a possible interest rate cuts, possible interest rate cut because of what must have been said in the symposium and the message, and then what we have in the data. However, if the reverse is the case, where in the symposium the interest rates the inflation data was much more alarming, and then we have a better employment data for August, then it's possible that we might be seeing the Fed tilting towards keeping the interest rate the way it is, or taking it up a little bit. But these are not set in stone. I think one of the major things I've experienced as a trader is having one thing in mind, or we are all having one thing in mind, as the whole market is expecting one thing, and then we get a shocker, at the end of the day, where the Federal Reserve goes the other direction entirely, So it's not set in stone, and there is no 100% approach to it. There is no, because they're saying this and this data is doing this, it means definitely this is going to be this. No, it doesn't work that way. It's like I said, you still have to just keep an open mind and just look out for what is going to be happening at the day, and then position yourself a little bit for what you are expecting based on all the data and based on all that is going to be discussed during the symposium. So majorly, back to the question, I think for traders right now, they should be paying attention to the August data, because that is going to give us a huge hint as to what to expect for September.
Employment data, that's going to be for sure one data set that we'll be taking a look at, and one that should be a priority to look at for interested traders and investors, especially for those looking at the Jackson Hole 2026. It is happening on August 27th to August 29th, for your information. This has been Precious David, Senior Market Analyst at EBC for the Nigeria branch. You've been listening to the Pulse 360 podcast, brought to you by the EBC Financial Group. I'm your host, Norman Chella. Thank you for listening to the episode, and I'll see you in the next one.
That's all for this episode of Pulse 360. Like, share, and follow the podcast for more conversations from EBC Financial Group. Thanks for listening, and we'll be back with another exciting episode soon. The content of these materials does not constitute a recommendation from EBC Financial Group and all its entities, also known as EBC. EBC is not providing any financial, economic, legal, investment, accounting, or tax advice through this material. The views or opinions expressed represent those of the speaker, and not necessarily those of EBC. This material, regardless of format, should not be copied, shared, or reproduced in whole or in part without written consent from EBC. Past performance is not a guarantee of future results. EBC does not verify the source or accuracy of all information presented, and disclaims all liability for any direct or indirect loss arising from its use. Receiving this material does not make you a client of EBC or constitute investment advice. Trading Forex and CFDs on margin carries a high level of risk and may result in significant losses, even losses exceeding your initial investment. Please ensure you fully understand the risks and seek independent advice where needed.